You're listening to The Intellectual Investor, episode number 142, Welch versus Bezos, written by Vitaly Katzenelson and read by Elliot. To read this article online or to listen to more episodes, visit investor.fm. To learn more about Vitaly's investing firm, IMA, go to imausa.com. Welch versus Bezos. A lot of times, I won't have an insight into a business because I don't understand it, or because it's too complex. General Electric is a great example. As a value investor, I should be all over this iconic stock, which is making a generational low. Not at all. I have looked at GE at least half a dozen times over the years, and always have walked away without understanding the business or what it's worth. To make things worse, despite GE's being one of the most admired companies in the US, I have always hated its culture. Former CEO Jack Welch went into the corporate history books as the best American CEO ever. I'd argue that this history needs some serious rewriting. Welch built a company with a beat-this-quarter culture. Welch's GE was not in the business of building moats and investing for the long run. He was in the business of beating quarters. In his book, Welch raved that from the early 2000s, GE always beat Wall Street estimates. He was proud of how managers of one division were able to come up with a few more cents of earnings if another division fell short of its forecast. I kid you not. Re-listen to that sentence 3 times. If I was at the SEC, I'd investigate GE's accounting. GE played games with its earnings for a long time, but in reality, its cash flows couldn't cover its dividend, which was supposedly half of its earnings, and that triggered a wake-up call for investors. GE is another reminder that it is incredibly dangerous to own a stock just because you like the dividend. Consistency of recurrence of dividend payments creates an optical illusion that the dividend will always be there. Just think about it. GE's dividend of 96 cents was half of what the company was expected to earn, and it still couldn't afford to pay it. Welch is on the opposite end of the spectrum from Jeff Bezos, CEO of Amazon.com. Bezos doesn't even know how to spell quarterly earnings. Amazon's founder once explained that Amazon makes decisions years out, so the current quarter's report reflects decisions Amazon made several years ago. As an investor, I don't want to own companies that are run by the likes of Welch, but my firm does have positions in a few companies with CEOs who have similar approaches as Bezos does to running a business. We don't own any Amazon shares, though. Whenever you hear management praise their ability to beat last quarter's earnings, run. GE was ultimately destroyed by enormous capital misallocation. Management assumed anything they touched with Six Sigma, a process designed to improve a company's operations, would turn to gold, regardless of the price they paid. Accordingly, GE wasn't concerned with how much it paid for acquisitions. There is another lesson here. As an investor, simplicity and transparency from a company is key. If a company's business is complex and opaque, move on. One of the most important things in investing is what you do in between buying or selling a stock. After you buy, it is just a matter of time before your initial assumptions come under fire. Maintaining rationality throughout your ownership of the company is paramount. And to do that, you need to understand the business well. That's why I have no opinion on GE shares now. Once in a while, after my firm has done extensive research on a business we understand, I may have an opinion that runs contrary to the markets. In those few situations, you can drive a truck between the stock price and what we believe the company's value is, and this is when we dig in and become contrarian-driven buyers. Above all, never make a decision based solely on someone else's research. Use it as a starting point for your own investigation. Tips on how to do this are included at a link in the show notes. And keep in mind that any media reports, or even sophisticated brokerage research about a company, are just snapshots of the moment. If the facts change, be able to change your mind. And one more thing. I am not a journalist or reporter. I am an investor who thinks through writing. This and other investment articles are just my thinking at the point they were written. However, investment research is not static, it is fluid. New information comes our way, and we continue to do research, which may lead us to tweak and modify assumptions and thus change our minds. We are long-term investors and often hold stocks for years, but as luck may or may not have it, by the time you read this article, we may have already sold the stock. I may or may not write about this company ever again. Think of this and other articles as learning and thinking frameworks, but they are not investment recommendations. The bottom line is this: if this article piques your interest in the company I've mentioned, great. This should be the beginning, not the end, of your research. Thank you for listening. This and other investment articles by Vitaly Katsenelson are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast, titled The 6 Commandments of Value Investing. To learn more about how Vitaly's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.